Two people walk into the same bank on the same day. The first person overdrafts their account by $2. The system automatically charges them $35. The second person walks past the line entirely. A banker greets them by name. They're offered a seat in a private room, maybe even a coffee. What's the difference between these two people? About 6 zeros in their bank account. Same building, same bank, two completely different realities. And here's the part that will genuinely disturb you. There are actually two banking systems running at the same time. One for ordinary people, one for the wealthy. And right now, without realizing it, you are fully enrolled in one of them. The fees you pay, the interest you earn, the products they offer you, the way they speak to you, all of it is determined by one single number, your balance. And once you see how deep this goes, you will never look at your bank the same way again. Here's what most people believe. They think a bank is like a public service, like running water. Everyone gets the same thing. That belief is costing people thousands of dollars a year, because banks are not utilities. They are businesses, profit-driven, data-obsessed businesses. The less money you have, the more you pay. It sounds backwards. It sounds almost illegal, but it is happening to millions of people right now, and it is completely by design. Let's go level by level. Level 1, the broke tier, under $1,000. Meet two people. Same age, same bank, same day. Yusuf has $100 in his account. He's working hard, doing his best, trying to get ahead. Then one afternoon, he miscalculates by a few dollars. He's $2 over his balance. The system doesn't call him. The system doesn't warn him. The system automatically charges him $35. For $2, that's a 750% penalty. Yusuf also pays a monthly maintenance fee just to have the account. He pays ATM fees every time he's not at the right machine. His savings account earns 0.01% interest. Onto $100, that's less than 1 cent per year. Meanwhile, the bank is lending out Yusuf's $100 at 20%, 20%, sometimes 24% interest. He gets a fraction of a penny. They make hundreds of dollars, and they still charge him fees on top. If you're wealthy and you overdraft, a manager calls to help you fix it. If you're poor and you overdraft, an algorithm automatically punishes you. This is not an accident. The banking industry generates over $15 billion a year in overdraft fees alone. The majority of that money comes from people with low balances. The people with the least are funding the profits the most. But here's where it gets even more interesting. Because the next level, the middle class tier, is actually the most dangerous of all. And almost nobody sees why. Level to the middle class tier, $5,000 to $50. Oh, this is the most dangerous place to be in the banking system. That not because you're suffering, but because you're comfortable enough to stop questioning anything. At this level, the bank gives you just enough to feel like you've been upgraded. The monthly fee disappears as long as you keep a minimum balance. You get a slightly better credit card offer. Maybe a banker who remembers your name. You feel taken care of. That feeling is the trap. Your savings account earns approximately 0.5% interest. Inflation is running at 3% to 4%. Your money is melting in slow motion every single day. You think you're being responsible by saving. You're actually falling behind in slow motion. The middle class is where banks make people feel financially successful while keeping them financially stationary. A person in the broke tier loses money through fees. A person in the middle class loses money through missed opportunity. One is a punch, the other is a slow leak. Both drain you. Only one feels like anything. Now hold on, because once we cross the next threshold, the rules of banking change so dramatically. It almost feels like a different industry entirely. Level 3, the comfortable tier, $100,000 to $1 million. Here's where the curtain starts to open. At this level, the bank starts calling you. Suddenly there's a personal wealth advisor who wants to have coffee. Suddenly fees start disappearing with it, you asking. Suddenly loan interest rates drop. Because now the bank isn't just holding your money. They want to manage it. Managing money through advisory fees, investment products, and cross-selling is where banks make their real margins. They've shifted from extracting money out of you to extracting a percentage of your growing wealth. You've entered the first version of the second banking system. But what happens at the very top? What does banking look like when you have genuine wealth? Brace yourself, because this part is almost unbelievable. Level for the wealthy tier $1 million and above. At this level, you stop being a customer. You become a client. Private banking. A dedicated relationship manager available on their personal number. No fees ever. Interest rates on your deposits that regular customers don't even know exist. Access to investment products the average person cannot find on any website or brochure. Prepo shares, private equity deals, exclusive real estate funds, opportunities behind a velvet rope. Banks will actually pay wealthy clients to keep their money there. Not symbolically, literally pay. The wealthy don't use the bank the way you were taught to use the bank. They use it like a tool that works for them. Because at this level, the bank needs them more than they need the bank, and the entire relationship flips. So why does this system exist? The official explanation is something called risk-based pricing. More risk, higher fees. It sounds logical. Almost fair. But here's what it actually creates in the real world. A system that punishes people for being poor and rewards people for already being rich. It's like a gym that charges you more money the heavier you are, and gives free membership to people who are already in perfect shape. When people are under financial pressure, the brain shifts into survival mode. Short-term thinking dominates. Stress consumes mental bandwidth. This is called scarcity mindset, and it's been studied extensively. The person drowning in fees is the least mentally equipped to make smart long-term decisions. Wealthy, under no such pressure, think long-term naturally. Invest calmly. Plan confidently. Poor people think banks store money. Middle-class people think banks keep money safe. Rich people know banks are a mechanism for building wealth. Same institution. 3 completely different relationships with it. Step 1. Move your savings. Yield savings accounts, mostly from online banks, are paying 4% to 5% right now. That is 10 to 20 times what a traditional bank offers. The product exists. The only barrier is that nobody told you. Step 2. Engineer your credit score. The difference between a 620 and a 780 credit score on a home loan, sometimes $300 to $500 per month. Over 30 years, that's over $100,000. That is the tier system made visible in one number. And unlike your income, it's something you can directly engineer. Step 3. Stop using the bank as your only tool. Banks are designed to hold and move money. That's it. Wealth is not built inside a savings account. At whatever amount you can manage, money needs to start compounding somewhere outside those walls. Index funds, fractional real estate, dividend assets. There are 2 banking systems. One is designed to be used by you. One is designed to work for you. The difference between them isn't talent. It isn't luck. It's awareness, and then action. The moment you understand which system you're currently in, you stop sleepwalking through it. Poor people think banks store money. Rich people know banks manufacture wealth. And the moment you understand that difference, you stop acting like a customer, and you start thinking like an owner. That shift doesn't require $1 million. It requires a decision. And you just made the first one by understanding the game. Now the question is simple. Which system are you going to start building toward?